Hey guys, this is Drew with Yieldcraft, and in today's video we're talking about the Great Melt-Up, why asset prices continue to rise, and what you can do about it. More specifically, we're going to cover the US government financials, how foreign governments are reacting to all this, how asset prices are responding, and what you can do to profit. So let's go ahead and dive into the US government financials. First, let's take a look at their P&L. It's not looking super rosy. If we look at the last 50 years, they have only made a profit 4 of the last 50 years, and they've clearly been spending a whole lot more than they're making. And it's projected to continue into the future as well. We're not necessarily planning on making more than we spend. And as we're going to break down here, this is a huge problem. But first, let's take a look at the revenues and see if there's any wiggle room and see what we can do there. If we take a look at what's actually funding the federal government, it's mostly employees. It's mostly me and you. There's a small corporate tax, a small excise tax, and a few other things that they do to raise money. But by and large, it's me and you that are funding the US government. So how are they spending our money? Well, if we take a look at this chart, it'll kind of break it down a little bit more for us. This is data from 2024, so it's slightly out of date on this, guys, but it's mostly you get the main picture. It's mostly the same for 2025. What you see in blue is mandatory spending. That's promises that we've already made. So we can change this, but we have to really do some serious shifting in order to do so. There's also discretionary spending where we have some wiggle room, and interest where, as we're going to kind of see, we don't really have as much wiggle room. But what's worrying about this is if you see kind of right off the bat what's discretionary, it's only 27%. There's not a whole lot that they can take out or change for this to fit these expenses. And if we take a look at some projections for 2035, there are a lot of baby boomers that are going to start retiring and collecting on Social Security and needing Medicare and Medicaid and whatnot. So they're going to go up. Medicare is projected to go up 100%. It's projected to double. Medicaid is projected to go up 60 to 80%. Social Security is projected to go up 40 to 60%. And interest is going to go up 80 to 90%. Because, of course, we're going to be spending more than we're making, and that's going to make our interest payments go up. And what you can kind of see from this is going to put pressure on our discretionary expenses. And if we take a look at what that's projected to look like, well, it's already shrunken a lot. From 1975, we had 48% of our budget as discretionary. Now we're down to 26% of our budget is discretionary. And by 2055, we're projected to only have 19% as our budget of our budget as discretionary. Now, let me ask you a question. What do you think they're going to do? Do you think they're going to cut spending? You saw how that went with Elon Musk and Doge. Do you think they're going to raise taxes and raise taxes on us as individuals or as at corporations? I don't think so. I think what they're going to do is, instead of, worrying about like their income and their expenses, they're just going to grow the pie. So instead of taking 26% of 31 trillion, they're going to take 19% of 90 trillion. And that's how they're going to keep the ball rolling and keep paying their bills and keep the lights on, is they're just going to inflate this debt away. Let me show you what I mean. If we look at this chart here, this is the Federal Reserve asset sheet. So when you hear the term quantitative easing or money printing, this chart shows exactly that. It goes back to 2002, and as you can kind of see, recessions are really a huge factor when it comes to money printing, because in 2008 we printed a ton of money to bail out the banks. In 2020 we printed out a ton of money for COVID, and as you probably already know, that really affects asset prices because there's more money in the system. That money buys less and less over time, and as you can see, we're overall trending upward over time. This is just the Fed balance sheet as far back as it goes. If you look further back, it's just up and to the right. And if we take a look at the debt to income ratio, this also paints a little bit more of a picture as to, how we're doing financially. And because if we take a look now as 2026, we're around 10. So around 10. So to kind of put this in more simple terms, if the government is making $100,000 a year, our debt is $1 million. So we're like a student fresh out of med school, right? We have quite a bit of debt, not that much income, but it's still kind of possible long term. But if we don't, start paying down some debt and start raising our income a little bit more, we might run into an issue where we can't ever pay that debt. And that's sort of what other countries are seeing now as well. And we'll get to that in a second. But if we flip over to the interest rates, what immediately stands out is this huge spike in 1980. What happened here was inflation kind of ran away from us in the late 70s. It went up to like 13% inflation, super, super high. So what they had to do is really raise that interest rate to tame down inflation and get it back under target. But if we take a look at 1980, we only had a 2.5 debt to income ratio. Today, we're at a 10. So even if inflation does take off, we don't have the flexibility like we used to have to raise interest rates like we did. Sure, we can raise them a little bit here and there, but as you're seeing from Donald Trump's reaction to the Fed not lowering interest rates quick enough, that's not in their game plan at all. They want lower interest rates and they want to keep them there so that way they can add more to this debt and not have to worry as much about paying it back. So how are foreign leaders reacting to this? Well, they're sort of seeing the writing is on the wall a little bit. 33 countries are fleeing the US dollars for gold. And by that, they're dumping or reducing their US treasuries and they're accumulating gold, right? Over the last few years, if we take a look at central banks, they have been doing record buying for gold, right? 2022 is an all-time record. 2023 was just about an all-time record. 2024 was about an all-time record. And 2025, this is estimated at 1,500 plus tons. It was actually closer to 400 tons. So they did a lot less buying in 2025. But the price of gold in 2025 went up, I think, 60%? So they knew this was coming. And what's really interesting is gold isn't meant to be this growth asset that goes up 50% or 60% in 1 year. It's kind of designed to be a store of value over time. So what else is going on? Well, they formed BRICS. I'm not sure if you've heard much news on BRICS lately, but it was initially an alliance between Brazil, Russia, India, China, and South Africa. Since then, they've added a handful of countries. That's why it's called BRICS Plus now. But there's a rumor going around that they're creating something called BRICS Pay, or the unit structure. And it's essentially their own currency that's backed by gold, by physical gold, and a basket of BRICS currencies. And why this is a big deal is because if they do ultimately move towards the unit instead of the US dollars, as you can see at the bottom, this is a huge chunk of the world population and the GDP. So this could cause conflict and rising tensions in the future. Not trying to fearmonger here, at least right now, it's a rumor, right? This isn't actually out there yet, but and I think this is political just as much as it is financial. But they're seeing that the US dollar is collapsing and they want to flee to safety, which is why we're seeing gold go up so much in value. So, how have asset prices reacted to this? Well, you probably already know. If you take a look at gold, this kind of tells the story. I've been talking a lot about gold lately, and the reason being is because of this right here. The United States used to be on the gold standard, where the dollar was backed by gold, and that's why it's so flat over here. The dollar retained its purchasing power, but in 1971 we got off of the gold standard, and instead of our currency being backed by gold, it's now just backed by trust in the U.S. government. And, well, the rest is history. You can see kind of where we're headed there. And keep in mind, this is the exact same thing, but it's just worth less and less and less over time. Let's look at housing. Same thing Same kind of story in housing. You were told a long time, if I was told growing up anyway, that housing just goes up over time. Housing just goes up over time. Just buy and hold, you know? But if we look at housing priced in gold, it hasn't. You know, it hasn't really truly gone up. And it's fascinating to me because if you look at, you know, today where housing is mostly unaffordable for the average person, if it was priced in gold, if we kept the gold standard, it'd be cheaper today than it was in 1990. That's hard to stomach right there. At least for me, it is, because it really is insane how much housing prices have gone up here in the United States. It's gutting. So let's take a look at the S&P 500. Right, that's kind of what we're all here for. We're here for stocks and seeing how we can profit from this. But if you take a look kind of over the long term, of course, we're up and to the right. Of course, there are dips, there are depressions, there are recessions, but it's mostly up and to the right. Not so much if it's priced in gold. If we price it in gold, which again, you can think of that as like the base, the stable. It is about the same as it was it back here when we crossed it back in 1960. And one thing that is worrying a lot of people, myself somewhat included, is if you take a look, these gray bars here are recessions. And if you kind of look, there's a little bit of a pattern where this shoots down right before there's a recession. You know, right here, shot down, recession, shot down, recession, shot down, recession. And if we take a look at most recently, it's shooting down. So that's why certain people are thinking that we could be heading into a recession. Personally, I don't think it's going to happen yet. I think we could be on the cusp-ish, but I don't think we're going to get there yet. But that's for another video. So what can you do about all this? What can you do from the collapsing US dollar value? Well, you can work towards getting more cash flow. Track your income. Track your expenses. Don't be like the US government and make more than you spend, right? Track where that's going. See what you can do to like pick up a side hustle or do whatever you can to increase your income and lower your expenses. You know, take a look at your monthly subscriptions, all that good stuff. Because what you can do with that difference is buy assets. More specifically, buy a diversified portfolio of assets. A lot of people like to do just stocks or just precious metals or just crypto or just real estate. But I suggest that you should look into acquiring all of them. Maybe not all at once, maybe one at a time, but eventually you should try to diversify into all of these, right? And if you want to really get ahead, you can use some leverage. Now, this is a controversial take, but I gotta be honest with you. You can get ahead a little bit by, you know, if you're making 60 grand a year and you plow $1,000 a month into stocks. Yes, that is going to accumulate over time, especially over a long period of time. But if you really want to get ahead, borrow these dollars, because like the US government is doing, these dollars are just going to get inflated away anyways. So over time, your debt that you have for these assets is just going to go down and down and down. Now, this comes with a couple caveats. The first one is you make money when you buy, not when you sell. You have to really time your entry points, especially when you're using leverage, because leverage bites both ways. You can get wrecked from leverage. There's no doubt about that. But if you play your cards right and you do heavy research going into it, and you go in with some conviction, you can absolutely get super far ahead in a pretty short amount of time. So, not financial advice. I'm going to be covering more videos on this in the future. I just want to give you a bird's eye view of what's going on with the government and the economy and how other people are reacting, because there's a lot of moving parts right now, and there's a lot of people that are scared. And I totally feel you, because I'm right there with you. But you have to be invested into assets, because over time, you're just going to get more and more value from it. So I hope this video has been helpful. Please let me know what you think in the comments. Hope you're having a great day, and I'll see you in the next one.